Hello, this is Charles Weeks with the Barrister Brief. Today, I want to discuss Fed rate cuts and what it may mean for the economy, for markets, and for our personal finances. Fed is set to cut rates 25 basis points on September 18th. There's some talk that they could potentially cut by 50 basis points, but it's much more likely that they'll start with a smaller 25 basis point cut. So, what does that mean for us? What's it mean for our portfolios? And what's it mean for the economy going forward? A lot will depend on if the Fed is cutting into a slowing economy or kind of a sustained economy. Um, the data suggests right now unemployment numbers are starting to go up. GDP is starting to slow down. That the Fed is cutting into a slowing economy. So uh, I'm sharing with you this chart from Bank of America, Global Strategy, and you can see it broke down the first Fed rate cut and what was kind of going on more from an economic perspective. If it's going to be a soft landing, meaning that GDP would kind of sustain at current levels. If it was going to be a hard landing, I mean, we're going to go into a recession, or if there was some type of liquidity event that caused the Fed to cut rates. So, three main different scenarios where the Fed was cutting rates. If you can imagine, the Fed cuts rates just to slow things down, or it cuts rates because things have already slowed down and kind of things are getting really negative, or there was some big liquidity event. For example, the fall of long-term capital management, the 87 stock market crash, where the Fed had to quickly create liquidity to avoid some catastrophic type market event. So if we look at the data, what's going on right now, it would seem that the economy is slowing down, and we're more likely, in my opinion at least, to be facing some type of recession. So what does that mean for forward-looking market returns? If we look at this chart and we look at the S&P 500 over the very short term, the next 3 to 6 months, on average, it's been negative. There's some years, as you can see, especially in the 70s, and then also the dot-com crash, and then even before the great financial crisis, where we had these negative returns. And those negative returns actually got a lot worse, for example, with the great financial crisis. In my opinion, there wasn't just a hard landing with the great financial crisis. We also had this giant liquidity event where we had all these bad investments sitting on banks' balance sheets that really caused not just to slow down the economy, but also this big liquidity event as well. So, of course, we don't know exactly what type of environment the Fed is cutting into, but if you look at some of the indicators out there now, things like the manufacturing index has been really low for a long time. We've had this inverted yield curve, which is a signal of a recession, and we're coming off of really high valuations in markets as well. So we've been in this really just robust, bull market for a long time, and then we've had these couple of years where we had these pretty big pullbacks in the markets. So it would seem that you hate to say that we're due, but it would seem like we would be due for some type of recession. Now, what this chart doesn't show is kind of more forward looking, beyond those short term 3 to 6 month returns. In some of these years, the markets could bounce back from these bad returns over the short term. In other years, again, I go back to the dot-com blow up and then also the great financial crisis, the 3 to 6 month returns were not good, but then there's also multiple year returns were not good either. So again, what keeps me up at night, what makes me nervous right now about where we are in the economy and where we are with markets? Really high market valuations. We have a lot of government debt, big deficit. We have a lot of consumer debt out there. The record 1.14 trillion in credit card debt. That doesn't even count kind of the shadow credit card debt that I like to call, things like Afterpay in a firm, where you don't necessarily, you're not borrowing money, but you're making these payments over time. And if you miss payments, then it becomes kind of like a credit card. So we're not even counting those dollars. But the consumer is definitely starting to get squeezed. Housing affordability is at all-time worst levels. Car payments, car prices are high. Interest rates are high on those car loans. So there's a lot that's really squeezing the consumer right now. That leads me to believe that, you know, we were going to have some type of upcoming recession. It's why we've been defensive with our portfolios for some time now, and believe that that's still the smart strategy to take at this point. So, I want to share with you some other charts. Kind of, you know, interesting chart here from Dollar Tree. This is from Creative Planning, and this is drawdowns, 1 day percentage price changes on Dollar Trees. I shouldn't say drawdowns because it could be they've had, obviously over this chart they've had from 1995 some really great 1 day gains, but then they've also had some really poor 1 day percentage losses. So what's interesting to me though is the timing of some of these really big percentage losses and around, recessionary times. So if you go shoppers at Dollar Tree, value shoppers don't have a ton of discretionary income for the most part, generally speaking. So they're looking to save money on shopping. So consumers with maybe limited budgets or value shoppers that would potentially get hit first and be kind of the canary in the coal mine for something bigger that might be going on. So if you look at back in the 0102 timeframe, the dot-com blow up, the '08 great financial crisis, pre-COVID, and then also recently this one really big over 20% drawdown. So Dollar Tree is getting squeezed. Those consumers are getting squeezed. In the earnings report, the CEO specifically called out inflation and the impact it's had on their shoppers and their inability to, be able to go buy whatever they want, and how they've limited shopping at a place like Dollar Tree. So not an exact science here saying, well, look, this stock's performing poorly, we're definitely going to have a recession, but an interesting indicator of something that it could be letting us know, that these shoppers are hurting. That's soon going to spread to kind of middle markets and then the higher end shoppers as well, higher end consumers, I should say. And then I want to show one more interesting chart. This is from Ritholtz Wealth Management, and it speaks to why we are defensive right now with our portfolios. And also, though, once things start to turn and we rebalance, and if we do have a really bad market return or a couple of years of bad market returns, how over time it still pays, I should say, to keep a portion of our portfolios invested for the long term. Now, again, we're defensively allocated. We're not fully invested in what our normal equity allocations would be across the board for our different risk tolerances, but we still have money invested in those markets. We are trying to avoid large drawdowns on the equity side, and that's why we're defensive right now. Because as you can see, for example, in 2000, the year 2000, we had a 9% drawdown in that year in the S&P 500. The following year, 2001, we followed with another 12% drawdown, and then in 2022, a 22% drawdown. So we had 3 years of negative returns in a row, which, what kind of impact did that have long-term for the long-term equity investor that was investing in the S&P 500? Well, if you follow the chart and look at years forward on the left, column 2, after 2000. So if you would have invested right January 1st of 2000, the S&P 500, you lost 9%. The following year, you lost 12%. Your 2-year return was minus 11%. And you stayed invested. You stayed the course because you know it doesn't pay to go all in or all out. And in 2002, you lost another 22%. So now 3 years invested, you're down 15% over those 3 years, annualized returns. Well, how long did it take before you finally had a positive return? Well, you had a positive annual return in 03 and another one in 04 and another one in 05. But it wouldn't have been until year 7 that you would have a 1% annualized return on your investment. So you would have been negative through the first 6 years of investing. And then you finally get this 1% return. You're starting to feel better. Year 8, you have a 2% annualized return. And then we have another big drawdown in 2008. You have a 37% loss. And all of a sudden that pulls your positive return negative. So your experience over a 10-year period from 2000, 10 years out, was an actual negative 1% return on your money. So it's, you could have a lost decade of investing if you invest in years where the market, performs poorly for multiple years in a row, or it doesn't bounce back as quickly. Now let's go forward to 2008. 2008, you had a negative 37% return, but 2009, 10, 11, 12, you had all these positive years right after that. And what that did was it allowed you to very quickly make up your losses and then have a positive return in year 5. So if you would have invested in '08, really bad timing, you got started with a negative 30% drawdown, big loss. By the 5th year, you had a positive annualized return if you would have stayed the course. So again, what's this chart tell us? In a really cool, picture, it shows us the longer, time frame you stay invested, the more likely you're going to have positive returns. But there is potential when you have big drawdowns to have a few years of negative returns after. The larger the drawdown, the longer it's going to take us to make up our money. So again, in certain times, it pays to focus on protecting capital versus growing capital. I feel like this is one of those times. From just a straight number standpoint, if you think about if you lose 50% of your money, so if you have a 50% drawdown, you start with $100, you lose 50%, you're down to 50. You now need 100% return to make up your money just to get your principal back, to get yourself back to even before you can start to grow your money again. So we're really trying to protect capital right now, with just a lot of kind of, in my opinion, red flags out there from the market, from the economy, just valuations, economic things that we're seeing to say that, we could be in for a recession. Not to mention, commercial real estate, the impact that has with banks and what's on their balance sheet. Banks are still carrying a lot of unrealized losses from their fixed income investments, from their bond investments, when the Fed cut rates so hard and so quickly, that really pulled down valuations. Now, again, I mentioned the Fed is supposed to start to cut rates on September 18th. They're going to start with a 25 basis point cut. So, that's what's expected. So what does that mean, though, just for our personal finances? What can we expect right away from this Fed rate cut? Outside of just the market, what's it mean just for our everyday finances? Well, right away, or very quickly, you should see a lowering of the yield on things like your high yield savings account, or if you're getting any kind of uh, interest on just your regular checking account, right? So those things right away, we're going to see an immediate, lowering of those money market funds. You'll start to see a drop in the yields there with the Fed cutting rates. You're going to see a lowering of your credit card, if you're going out to buy a new car right now, a new car loan or used car loan, potentially that should, it always seems to flow through a little bit slower on the debt side of things than it does when we earn interest. We should see a slight pullback in credit cards. Again, 25 basis points is not a huge cut. It's not going to have a massive impact right away, but it will help to lower some of those borrowing costs. Is it going to have a big impact on mortgages? Is it going to change the housing situation? It will. Mortgages are based off of mortgage-backed securities, which are kind of more forward-looking. So if you've seen mortgage rates, they've already dropped a lot with this expectation that the Fed is going to cut rates. So I don't foresee a big change there because of the Fed rate cut. Housing affordability, again, is at its worst levels historically ever. So how do we make housing more affordable? Unfortunately, for people looking to sell their house out there, I think that means that we're going to have to see more price cuts, because I don't foresee us getting back to 3%, Fed fund rates and low mortgage rates anytime soon. I know President Trump has said that if he gets elected, he's going to make sure that we get back to 3% mortgage rates. I read that recently. If we get back to super low rates again, it's, in my opinion, going to be because of a really, really, really bad economy. And that would be the only way that the Fed could really lower rates again like that without causing this massive inflationary spiral. So if you remember why we talked about in past Barrister Briefs, and I've written about in Barrister Quarterlies, why did the Fed raise rates the way they did? It was the Fed trying to take the punch bowl away from the party to try to slow things down, because things had gotten so out of control with inflation. If you remember, used cars were appreciating. That's not supposed to happen. That's never happened before. Things like that. Housing prices just astronomically increased. So the Fed wants to raise rates to slow things down. You're trying to thread the needle here where they want to slow things down to a point to not cause a recession. Whether or not they're going to be able to do that, remains to be seen. Historically, again, it really depends on how cool the economy has gotten by the point that they started to cut rates. And it seems like there's some signals out there that things are cooling with our economy. So the Fed rate cuts will have some immediate impact. It won't have, in my opinion, this outsized impact immediately. And I don't think we're ever going to get down to these super ultra low rates again in my lifetime. I think that's something that, again, if you look at interest rate cycles, end of World War II, we were at super low rates like we just recently were. We then went from the mid 1940s up to the early 80s, where we had this ever increasing interest rate cycle until Fed Chair Volcker had to really increase rates astronomically to kill inflation, made them at a point where then we had these falling rates for the last 40 years. So it's very likely, in my opinion, that we're going to be in this rising interest rate cycle for some time. So again, we'll see what happens on September 18th. We expect the Fed to cut 25 basis points, and we're going to stay defensive with the portfolios because, in our opinion, it's more important right now to protect capital than try to grow capital. So once again, always a pleasure to talk to you. And if you have any interest in learning more about Barrister, you can visit our website at www.barrister.net. Click on the news and views section, and you can watch previous Barrister Briefs and also read a lot of different writings from the firm. So take care. Have a good day.